Welcome to the Depth Dive. We are jumping straight into something pretty significant happening in UK finance right now.
hmm
It's the huge acceleration, really, of sustainable and ESG investing. We've gone through, well, quite a stack of sources you sent over articles, research, notes,
Yeah,
and they paint honestly, a remarkably clear picture of these market forces just moving.
that's right. And our mission for you today is really to, cut through all the noise around ESG.
There is a lot of it.
There is. And just give you the three kind of non-negotiable forces that are shaping where money's actually going in the UK right now. We're boiling it down to the essentials.
Yeah.
The institutional push, the generational pull, and that necessary regulatory guardrail that's trying to keep it all credible.
Right.
So if you need that shortcut to understanding, what's driving UK funds, uh, this is pretty much it.
Okay, so let's start with the supply side then. That's often the kind of silent engine, isn't it? We're calling it the institutional push. Your sources were like crystal clear. This isn't some niche product tucked away anymore.
No.
It's being offered broadly, even, well, aggressively by the major UK funds and crucially pension providers. Why is that institutional bit so significant?
Well, it signals maturity, doesn't it? I mean, when the really big players, the ones managing literally trillions of pounds, start actively pushing ESG products,
Yeah.
it's not because they all suddenly found their conscience overnight.
Right.
It's because they fundamentally redefined how they look at risk management. They see these ESG factors not as sort of optional ethical extras, but as core components of, well, long-term financial stability.
That's the key difference, isn't it? It's more than just ticking a box. But okay, if ESG investing sometimes means, deliberately excluding assets that might be high performing but high carbon,
Sure.
why are these big institutions deciding now that these factors are actually financially material risks? What changed?
Well, the sources point to really three specific types of risk becoming unavoidable. First, there's what they call transition risk.
Oh.
That's the financial hit companies might take as the UK economy shifts towards net zero. If you're
Okay.
holding heavy carbon assets,
They could become stranded.
exactly, stranded or just worth a lot less very quickly because of new rules or tech. Second, you've got actual physical risk.
Like climate change effects.
Yeah, the tangible stuff, flooding, extreme weather, impacting property values, insurance, agriculture, you name it.
And the third one, which seems to be getting, well, more and more important, reputational risk.
Absolutely.
Yeah.
Reputational risk hits a company's bottom line directly, affects its license to operate, its
Yeah.
ability to attract customers, good employees.
Yeah.
So by bringing in strong governance, social metrics, these institutions are basically protecting their investments against future scandals or, consumer backlash. It's just sensible long-term finance.
And you mentioned pension providers specifically. That feels like the ultimate proof point
Yeah.
somehow. Why the focus on them in the sources?
Because pension funds, well, they represent the mandatory long-term savings for nearly everyone working.
Right.
So when ESG options become standard in those funds, maybe even the default option,
Right.
it shifts the whole conversation. It's not some fringe ethical choice anymore.
Yeah.
It becomes about core fiduciary duty. These funds are investing for retirement dates 20, 30, maybe 40 years away.
Okay.
And over those timescales, those climate transition risks, the physical risks, they're undeniably material. So, yeah, the push from pension providers basically confirms sustainability is now baked into fundamental, generational wealth planning here in the UK.
So the supply side is strong. It's coming from the big players, and it's underpinned by this sophisticated view of long-term risk. Okay. Let's pivot then. Let's talk about the pull demand. We know the funds are building the products, but who's actually asking for them? Who's showing up, and why is that group so influential right now?
Yeah, the sources are really clear on this one. The demand, the momentum, it's being driven primarily by millennials and Gen Z in the UK.
Right.
And it's not just vague interest. It's a specific, pretty powerful demand for what the sources are calling values-driven investing.
And what's fascinating, I think, is how this group seems to be changing the whole conversation around what capital is for. For ages, the mandate was just financial return, full stop.
Absolutely.
Now it seems like maximizing profit without thinking about global challenges just isn't cutting it anymore for a huge group of future investors.
You're spot on. Values-driven really implies this generation sees investing as, well, a tool for aligning their money with their ethics, their social concerns.
So they want their capital to actively do something.
Exactly. Support climate solutions, push for better labor standards, ensure good governance, in addition to making a return. They're asking for transparency on the impact, not just the profit number.
Okay, but let me push back a bit here. Let me introduce some tension. What happens if the market takes a serious nosedive?
Mhm.
And suddenly, traditional funds, the ones maybe not excluding anything, are outperforming these values-driven funds by, say, 5 or 10 percentage points. Does that generational demand just evaporate? Do they ditch the ethics for higher returns? Is this values-driven thing really resilient?
That is like the million-dollar question for any ethical investment trend, isn't it?
Yeah.
But the sources suggest this shift might actually be different because it seems deeply connected to how this generation understands risk. For this group, the ones inheriting future wealth, the ones paying into pensions now, ESG is part of financial prudence.
Oh, good.
They recognize that the companies driving climate change or causing social instability today, well, those are probably the ones most likely to get regulated, fined, or just become obsolete tomorrow.
So you're saying they see the potentially higher short-term returns from traditional non-ESG stuff as actually carrying an unacceptable long-term systemic risk.
Precisely. The demand, this pull, isn't seen as purely altruistic self-sacrifice. It's viewed more like a necessary hedging strategy for their own long-term future.
Right.
And that's why fund managers have to listen. The values this generation holds today are basically setting the mandatory investment rules for tomorrow, especially in the UK, where things seem to be moving fast. Their money, their buying power, it's shaping the market's future structure.
It feels like an irreversible flow then, driven by demographics and this evolving perception of risk.
Okay, let's unpack this next part, because when you have this kind of rapid growth, strong supply push, enthusiastic demand pull,
Yeah.
there's always a danger, isn't there? A risk of opportunism, maybe cutting corners, quality control slipping, which brings us neatly to the third crucial dynamic, regulatory scrutiny, and specifically this threat of greenwashing.
Regulation is the absolute critical guardrail here. You have this rapidly expanding ecosystem,
Yeah.
and as ESG becomes this huge selling point, the sources rightly flag that UK regulators are actively, and I'd say aggressively, watching for greenwashing.
Okay.
Because without that check, the whole foundation of trust just crumbles.
And for anyone listening, we know greenwashing generally means making misleading claims, but how does it actually show up in financial products? It's often more subtle than just telling lies, right?
Yep.
Oh, much more nuanced in finance, yeah. Financial greenwashing, you could define it as marketing an investment product as having a bigger positive environmental or social impact than it really does.
How do they do that?
Often through, strategic omission, just not mentioning the negative impacts, or very selective use of data.
Mm-hmm.
So a fund might really shout about its small investment in wind farms while conveniently forgetting to mention its much larger holdings in, say, heavy industry or fossil fuels.
And because the demand is values-driven, as you said, the danger of greenwashing isn't just about people losing money, is it? It's potentially a massive crisis of confidence for the whole ESG movement.
Exactly.
If investors feel they've been misled time and again, they'll just get cynical and maybe stop investing ethically altogether.
That's the #1 concern driving the regulators, I think.
Yeah.
Their job is to protect the credibility, the integrity of the entire market. If those powerful millennial and Gen Z investors feel like they're constantly being tricked, they'll rightly just conclude ESG is just marketing fluff. And the genuine, important shift could just stall out completely.
The sources mention regulators are actively defining standards. What are they actually doing? What tools are the UK regulatory bodies using to make sure a sustainable label actually means something real?
Right. This is where it gets a bit technical, but really important. They're not just, wagging fingers. They're putting actual structural tools in place. Two of the big ones are disclosure requirements and taxonomies.
Okay, disclosure rules.
Yeah, forcing funds to report transparently how they're meeting their sustainability goals. What data are they using? What are the impacts? It makes their claims verifiable.
And taxonomies. That sounds complex.
It is, but it's crucial. A taxonomy is basically a formal classification system. It defines precisely what activities actually count as sustainable or green.
Ah, like a dictionary.
Sort of, yeah. It ensures everyone's using the same definition so you can actually compare different funds properly. It stops people just making up their own interpretation of green.
So if a fund wants to call itself sustainable, the regulator says, okay, first, you have to meet this specific definition of sustainable according to the taxonomy.
Right.
And second, you have to disclose the data that proves you're doing it. It's proactive, trying to set rules before the market gets totally out of hand.
Exactly. It's all about ensuring consistency, comparability.
Yeah.
Without strong enforceable standards, without that really robust regulatory framework,
Yeah.
all that huge institutional push and that genuine generational demand, it could just get totally undermined by bad actors jumping on the bandwagon with vague, misleading labels. The regulator's vigilance here is, well, arguably the most important piece for the long-term health and, frankly, the financial stability of the UK's sustainable finance sector.
Okay. We've definitely covered a lot of ground there. We've analyzed these three really powerful, interconnected forces that are fundamentally reshaping UK investment. Let's try and bring it all back together now.
Yeah, let's summarize it for you.
Yeah.
Essentially, the movement in UK sustainable investing is built on this kind of dynamic three-legged stool.
Right.
First leg, a strong institutional push, the supply side, driven by those massive UK pension providers and this whole redefinition of financial risk.
Got it.
Second leg, the powerful demand pull. That's coming from the values-focused millennials and Gen Z who see ESG as just smart long-term prudence.
Right. The generational driver.
And the third leg, that critical regulatory oversight, actively watching for greenwashing, using sophisticated tools like taxonomies and tough disclosure rules to keep it honest.
So it's this dynamic environment. Supply meets demand, but the regulators there making sure the trust isn't broken.
Exactly. And maybe here's a final thought for you to sort of mull over, building on all that.
Yeah.
Given how strong that institutional shift looks, how clear the generational demand is, and how necessary that regulatory scrutiny is,
Yeah.
the core question for the UK market, is, it seems to me, is no longer if ESG will grow. That feels pretty much baked in now.
The real question is how successfully the regulators can actually define and then enforce those standards. Because the entire credibility of this whole financial movement really rests on maintaining the trust of that incoming values-driven investor base, making sure their capital genuinely delivers the impact they were promised, avoiding that cynicism trap. Something to watch as you see those finance headlines pop up.